So with that, let's talk about our first topic, which is understanding the market, investment research, advice, and analysis. And I pulled this quote up from BlackRock, which I think was good. It's about, we are braving a new world of heightened macro volatility. So what do we mean by that? Well, you might have heard that the beginning of this year hasn't really been the best start for the stock market. In fact, it is one of the worst starts to the stock market since 1970. And so the S&P 500 was down 20%. The sell-off has been really broad. Pretty much every sector is down except for energy. Growth stocks have taken the biggest hit, which down 50 to 80% in some cases. And even market darlings like Disney and Intel are down. So what causes volatility? Well, there are a few things. We've got everything from political factors, economic factors, industrial factors, company performance, and investor market sentiment. So to give you examples, political factors include things like the war in Ukraine, the China-Taiwan tensions. Economic factors, there are a lot right now, everything from inflation, fiscal policy, interest rates, inflation, consumer spending, housing market, the unemployment rate, and the potential looming recession. Industrial factors as well are playing a part. So things like different regulations, industrial disruption, supply chain issues, oil prices, even in Sydney, the train and buses being on strike. And then we've got company performance. So everything that just happens day to day in a company, change of management, competitor disruption, Elon and Twitter. And then investor market sentiment. There's been a large drop in sentiment around technology companies and their growth prospects. But it's not all doom and gloom. If we look at this chart from Morningstar, we can see that since the 1870s, there have always been some dips in the market, many of which haven't lasted too long. But generally, the chart tends to move upwards and towards the right. So what can investors do? Number one, I'm sure you've heard this before, is don't panic. It's all about time in the market, not timing the market. Maintain a long-term view. Keep track of your portfolio. So again, we like to stress at Sharesight, looking at your dividends, looking at benchmarking, really important at a time like this. Keep an eye on your costs. It's really the only thing you can control. And leverage tech solutions like those of our wealth tech partners that you'll meet today, which can really help you to navigate these times. So now we're going to start actually our Q&A with our partners. So this section will feature David from Stockfox, Al from Simply Wall Street, Nathan from Otivo, and Mark from Morningstar. And folks at home or at the office, if you're listening in and you're struggling to see everyone, just change the grid view on the panelists to be able to see everyone, because we've got a lot of panelists today. So my first question is, with the market dip earlier this year, what trends have you noticed amongst your users? And we'll start with you, David.
Yeah, thanks, Angela. I think what I've noticed is that people have found that in recent years, every time the market's had a serious dip, that there's been some corrective action. So in the past, the Federal Reserve has trimmed interest rates, there's been additional liquidity. And so people are now used to being rescued, you might say. And I haven't seen a lot of panic selling as yet. I think people have seen some decent declines on some of the shares they own, but I haven't seen any sign of sort of complete capitulation. So I think a lot of people are waiting for something to happen. Right now, the trend seems to be towards higher interest rates and more inflation, so that's not necessarily great for the market. But I'm hoping at least that people have learned from experience that that panicking and selling after you've incurred a substantial loss is not always the right thing to do.
That's right. That's good. What about you, Al? Any trends that you've seen amongst your user base?
Yeah, I think it's really interesting because it depends a lot on like the type of investor, right? In that not all investors are the same. And what we've seen is in the last few years, a lot of new investors coming in. It's been a bull market for like 13 years, which is quite not that normal. And so you sort of, if you were to categorize them as investors who've been investing for, 10 years plus, and then you've got people who are investing, say, in the last few years. For a lot of those people, this is their first time this is happening. Even though, all the textbooks say this is normal, you should expect it, etc., that doesn't make it any easier for people, right? And so I guess what we see is people that have built up stock portfolios are over the number of years already. For them, this is actually something that some of them have been expecting for a long time, and some of them might even welcome, even though it's kind of painful. It has corrected a lot of what you've seen with tech, for example, which a lot of investors were scratching their heads at, saying like, how can this keep going? This bubble is not sustainable. And so it did burst, of course. And so those investors, I think that a market correction like this, if they're still planning on keeping their portfolio for, decades, then this isn't really phasing them. I mean, they might either say, I'm just going to pause and let things settle down. Some people are obviously investing because this still can be a great time if you've got I guess you could say the strength and you want to take the risk. But I would say that on the other side, the investors that joined more recently, who've started building their portfolio in the last few years, I think a lot of them are on hold. If I'm honest, I think this is too challenging for them. And so, so we're seeing different behavior with different investors. That would be my short answer.
Very interesting. It makes sense. Of course, everyone says not to panic, but it's of course very different if you've never lived through it before. So yeah, that's very interesting. Very cool. Nathan at Otivo, any trends you're seeing amongst your users?
Excuse me, so unmute myself. Yes, because we look at the whole gamut of someone's profile, so their cash flow considerations, we're seeing a lot of people really kind of hunkering down and looking at what they can do to mitigate some of these potential losses. So we see obviously the big stuff to be focused on. So refinancing their big debt is really a big focus, what we give advice on. And some alarming stats, like only 3.5 weeks people have in savings until they fall into debt if they lose their job. So cash flow is just really kind of is a focus for our user base. But I guess the main thing that we like to get across is that if you have a plan, if you have a strategy, our research says you're 3 times more effective, more likely to be financially fitter in the future. So I think the most important point from our thing is just to have a plan.
Yeah, for sure. Sticking to it, right? So important. Cool. And what about Mark? Mark from Morningstar. Any trends that you're seeing amongst investors?
Yeah, no, absolutely. So, I do think for the most part, a lot of our customers are taking it in stride. So we do have a pretty sophisticated group of customers that, I think realizes that over the long term, where we get returns is, of course, the trade-off for volatility, short-term volatility, which is what we're seeing with the market bouncing around. And I think the other thing is that we're very focused on valuations at Morningstar. And we have been quite vocal over the last year, quite vocal over this year, that the market has been and is overvalued historically. And, I think that message has hopefully come out with a lot of our users, either through our editorial content on Investing Compass, our podcasts, or our webinars. So, I think obviously when we do have overvalued markets, there basically is no margin of safety. And when things happen, whether that is, and I think it's a lot of the stuff that you went through, Angela, that, it's important, the context around things that add volatility to markets. When we have an overvalued market, when there isn't a margin of safety, they're going to have a bigger impact. And, I think kind of the final thing that sort of echoes a couple of the other things that the other panelists have said is, we are very focused on goals. We're focused on the long term. We built the product around that. And so, if you think about goals, you think about the return that you need to achieve goals, when the market falls, that return actually goes up. So you actually need a higher return to achieve those goals. And that really signals to you that now is not the time to take risk off the table. It's not the time to go into an asset class like cash or bonds that has less volatility, may make you sleep better at night, but also has lower long-term returns that are going to, in some cases, ensure you never achieve your goals. So, yeah, I know it's scary for a lot of people. I'm hoping most of our users and sort of the feedback we've gotten is most people understand that this does happen.
Yeah, that makes sense. And that actually is going to feed into a question I'm going to have for you later. So that's good, Mark. Thank you. Cool. So my second question for this section is has to do with financial advice. So according to Advisor Ratings, the cost of seeing a financial advisor in Australia is on average about $3,500 a year. So how are you seeing technology playing a role in bridging the gap? And I'll go back to David.
Yeah, I think certainly there's been a lot more regulation in the sector when it comes to receiving advice. In particular, if you are looking for a financial planner as such to look at all your, or look at all the investments that you might have, and that's something that Otivo seems very strong in. Then it's a matter of whether you're getting value for money. So I personally believe a lot of advisors in that space tend to take the easy option and just push managed funds, whereas my personal preference is obviously to be more direct investments. But I think yes, try before you buy. So if there are online services available they're cheaper than talking to a human, I think you can at least give them a try and see how they go for you.
Yeah, cool. Al, Simply Wall Street, what are your thoughts?
Yeah, I definitely echo what David said. Advisors are in Australia in a pretty tough spot with a very severe compliance that's put on them, which makes it very hard for them to do anything, frankly, that's unique and different. So what the problem you're having now is that when you go to the advisor, you can go to two different advisors and you pretty much get the same answer, right? And that's because it's very systematic, the advice they're giving you. So I think that it's not surprising that you're seeing, if you're going to spend that much on advice, it better be good, it better be worthwhile. And I think that's the really big challenge, is finding the advisors where they are adding a lot of value, and those advisors definitely do exist. And that's what you got to look for. But it's the industry is becoming a very challenging one to allow people to offer that, exactly what David said. So, and I think that technology is eroding those advisors that basically are just following a system. If an advisor is just following a system or a flow chart, that doesn't need a human. That can be done with software. That's a waste of human time, right? You might as well use software to do that. The whole point of the advisor is to apply their mind and actually make something that's personalized to the client. So yeah, that's my take on it anyway.
I know we're all biased here because we're all in wealth tech, but yeah, for sure, it makes sense to me. What about you, Nathan? Any thoughts?
Yeah, this is exactly the business that we're in at Otivo. So we know from research that 80% of Australians only want to pay up to $250. So it immediately rules out the ability for a human to become involved. So the obvious answer is that machines need to do what humans do. And I think Al was spot on. If it's a process flow, then a computer is definitely well and more consistent and less biased to do that task. So that's exactly what we're doing with the Otivo, and giving personal advice through the internet and delivering that for less than a cup of coffee a week. So it's not going to be the most. We're not going to cover the sophisticated, trusts and complicated family structures, but we think for 90% of Australians, what we're covering and dealing with a debt, with superannuation, with your retirement, and with your savings goals, we think that encompasses all the advice you will ever need. So, yeah, online's the future.
Yeah, that's cool. And having it all on one dashboard like you do is beneficial as well, right? Because you're seeing the full picture, which is really important. And finally, Mark, any last thoughts on this topic?
Yeah, I think in terms of financial advice in Australia, I think everybody knows that the system is broken, that people are not able to access advice. That's why the quality of advice review is going through right now. There's clearly going to be some regulatory changes next year. But, I think when we look at technology, I think, yes, technology can be helpful, but there's a lot of nuances around creating a financial plan and then executing that plan that technology really can't do. And that's because we're all different and we all have different goals and we all have different situations. And, I think the comments about replacing a workflow, yes, we can do that, but it's really understanding that situation and how that impacts your investment strategy, the different investments you pick, And so, yeah, I think more than anything, it's education, right? Because I think, certainly what we provide at Morningstar, what I think a lot of the other panelists provide, their tools, their data, their research, but that only works if you are financially literate enough to understand how to use those. And so, we, of course, do have a paid product, but a lot of our focus that, is free, whether it's webinars, podcasts, editorial articles, is around that education. And, more than anything else, and I think more than the issue we have with financial advice, is we have an issue with financial literacy in this country. And frankly, most countries, it's not unique. But, we all have more power to, whether it's superannuation, anything else, we have more power to shape our future, but none of that financial literacy has been provided, whether that's in traditional education institutions or I guess anywhere else. So I think that's the biggest problem. And, we need that to supplement any technology solutions.
Yeah, that makes a lot of sense. That's true, of course. Yeah, that's what you kind of get when you use these products. You kind of get that education at the same time, and you have to start somewhere. So yeah, that makes a lot of sense. Thanks, Mark.